I feel like at this point we need to do a little bit of Fed 101. The Fed has a mandate. It's actually got a dual mandate. It's got to do two things. It needs to focus on maintaining or achieving full employment while maintaining price stability. In English, what that means is, hey, we want to make sure that the economic conditions where a company would be forced to lay off employees, we avoid that. We want to avoid large layoffs, large unemployment. At the same time, we want to make sure that we manage inflation and the costs going up over time, because if we have inflation that gets out of control, that's going to be a bad thing for our economy. Now, one of the most important tools that the Fed has in its toolbox to address both of these dynamics is interest rates. The federal funds rate. Now, what is the federal funds rate? The federal funds rate is the government sets, or the Fed sets the rate at which banks lend other banks money for short-term overnight loans. So this is very common. It happens all the time within the banking world. We have a fractional reserve currency, which essentially means that if you deposit at the bank $1,000, you have $1,000 that's available anytime you want it. But at the same time, they're allowed to take $900 of your dollars and lend it out to someone's mortgage or a car or a credit card, and they can make interest on that money. Now, what happens if you want your $1,000 back? 900 of it is out in loans. So what the bank does is goes to other banks and says, hey, I just have a short-term credit or need for some cash. Let's do some swapping. They'll get some short-term money to make sure you are whole while they're still collecting money from other sources. It's a very common thing. Maybe you're comfortable with that. Maybe you're not. I'm not thrilled with it, but I understand it. That rate is a really important rate, and that rate influences a lot of things that happen in the economy. Now, here's the way it works. If the Fed wants to encourage risk-seeking or risk-taking behavior, growth and expansionary behavior, it can lower that rate, the federal funds rate. Now, remember, it's not just that rate affects the rates that banks charge other banks. That rate then has large ripple effects within the broader economy. Many business loans are set on that rate or a rate that's based on that rate. And many other loans and other interest rates are affected by that. So when it changes and lowers that interest rate, the cost to borrow money goes down. The interest rate on money in cash savings goes down. So you're encouraged to take the money that you're not earning much on and take more risk with it in order to get a better return. So you're encouraging risk-seeking behavior, which is expansionary towards our economy, which tends to encourage employment. Do you see how that works? When we lower interest rates, we're encouraging growth of businesses, growth of employee payrolls, which is good for our economy. Now, here's the negative. As the economy tends to heat up, what happens? Well, inflation, the cost of prices, the cost of goods goes higher. And remember, the Fed has a dual mandate. Not only do we have to worry about making sure employment is strong, we also have to make sure that prices are low or at least stable. And when we get to a place where they're pushing the one, employment, they're going to cause a problem on the other. They pull on the one, they tug on the other. So now inflation could become an issue. And as inflation starts to heat up, what is the Fed going to do? It's going to increase the federal funds rate, which tends to increase risk avoidance behaviors, increase savings, and make the cost of borrowing money higher. Therefore, the economy is generally going to cool a little bit, helping to tamp down the negative effects of inflation.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management, member FINRA and SIPC.